Welcome to a new episode of Opening Bid. I'm your favorite host, Yahoo Finance Executive Editor Brian Sozzi. Almost forgot my name there for a minute. I'm so excited about this episode. This is indeed the podcast that will make you, I think, smarter on all things investing and the leaders behind some of the biggest companies out there powering the market. Before we get going into today's guest, I do a little opening bid stock analysis. It's always the weekend. I was enjoying my tomahawk steak, feeling the good vibes here in New York City. The weather was great. And I came across, I was on Yahoo Finance checking stocks. That's what I normally do. And there's two stocks that are now at record highs that I want to call attention to. First up is Netflix. Record high for Netflix, really trading at valuations that I haven't seen in some time, 32 times forward earnings on a PE basis, according to the amazing data on our site. And really a lot of optimism being priced into Netflix shares because of all things related to their cheaper ad-supported tier. Investors are looking for really big growth expectations in revenue and profits over the next, I would say, couple quarters. Barclays analysts now calling BS on that move, essentially putting their or downgrading their rating today to underweight. What does that mean? Essentially, to me, as a former analyst, that's the equivalent of sell, saying it's unrealistic that Netflix will double its subscriber base and that valuation is too stretched. To me, that makes a lot of sense. Another stock that is hitting record highs, that is ExxonMobil. Shares up 25% year to date, only trading at 14 times forward earnings. The S&P 500 about 22 times. And really why this stock is trading at record highs shouldn't be any surprise. You have Middle East tensions. You have a lot of folks now positioning for potential $100 a barrel oil. Exxon shares at a record high. I would add this too. If you had to pick between each of these stocks, now I'm not picking stocks here, not making recommendations. Exxon's move makes a lot of sense, and the valuation does look very, very interesting considering where oil may go. And of course, Exxon is still digesting that very big Pioneer acquisition, which should really support earnings moving forward. All right, let's bring on our star guest for this episode here. This is Kathryn Rooney Vera, Chief Market Strategist at StoneX Group. Kathryn, good to see you. Thanks for reaching out to me on LinkedIn. I've been following your work for some time. Thanks for joining Opening Bid. We appreciate it.
Thanks, Brian. My pleasure.
So I was thinking over the weekend, still digesting that really strong jobs report, and I couldn't help but to think, is the economy just too strong? Does the market want to see jobs approaching 300,000?
You're right on that. That's the famous no landing scenario, and I call it the reflationary scenario because the underpriced risk right now is a reacceleration in inflation, and it's not just because of the risk to oil prices. It's the risk of an overstimulated economy. And let's face facts, the U.S. economy's potential growth is 1.8%, and it's growing above 2.8%. So I think that therein lies, I think, the main question, which is this actually a soft landing? Really, the Fed wants to get inflation down, and it wants to see a slowdown in the labor market. They're gaming for the not too hot, not too cold scenario, and we're just not there yet. How's
the economy in Miami? You're Miami based. Like, what's going on down there?
The Miami economy is very robust. It's firing on all cylinders. Of course, I'm from New York, New Jersey area, so I predated the mass migration down here, but it's still coming. And we do have a very strong economy, both from the labor market and from the housing market.
Why do you think the economy has been so, the word I'm hearing a lot about is resilient. You hear that often, but it's coming back into play now. You've had a series of rate hikes from the Fed. Of course, they lowered rates by 50 basis points, but still, rates are still relatively high, and you have economy by and large. To me, that seems like it's doing okay.
Well, the U.S. economy is really based on the consumption aspect. So if the U.S. consumer continues to purchase goods or services, in this case, overwhelmingly services, then we're going to continue very strong. Remember, it's 2/3 based on consumption, the U.S. economy is. And labor market is the primary driver of consumption. So while the labor market remains relatively strong, there is no earthly reason, Brian, for people to change their habits of consumption. So until there's a change in the labor market and a real change, the consumption of services will continue to be strong, and thereby inflation as well. Because the main driver of core PC inflation, it's core services x housing.
I saw that at my local Sam's Club. So I go to Sam's Club, which of course is owned by Walmart. Go to Sam's Club over the weekend. Baskets were full. Those are giant baskets. And look, that is not a cheap shopping visit at Sam's Club. But to your point, It seems like the consumer's hanging in there. They're saying, you know what, we're doing okay. Yes, goods and services are priced more, but we're still out there buying stuff. I don't see any slowdown happening.
There certainly isn't a slowdown, and I don't think a lot of economists still attach a lot of this strength in the U.S. consumer to post-pandemic dynamics. I think we're getting a bit past that at this point. I think the consumer is just feeling good because the truth is that real wages are doing okay. Yes, for sure there is a slowdown in hiring, but we haven't seen large layoffs or many layoffs really at all for the real economy. And I think at that point, that's when you see a change in the habits of consumption. Until then, until people still have their jobs and are still making money, and in this case, beating inflation, then you shouldn't expect to see a rollover in what is all of the purchases, as you mentioned, at Sam's Club or in my case, Costco. But I think even more importantly, the service sector of the economy, which remains the most robust. So really, what could change the trajectory? I'm not sure it's the Fed. I think that what has to happen here, and what I've, out of consensus, been thinking about for some time, is one aspect from the ramifications of the pandemic is job hoarding. At what point do companies, excuse my candor, but cut the fat of their employees? We haven't seen it yet. So once you see margin pressures and corporate profitability, which is at record highs, Brian, until you see corporate profitability shrink and margin pressures start to really hit home, companies really don't have an incentive to let go of their less productive employees. They're hanging on. They're just not hiring as much. So I think we get to a point where we get some margin pressure, potentially from a triple whammy of high oil prices, high real rates, and still high cost of labor, where companies start to let go some of that overcapacity, which we've called job hoarding for the past 4 years. And I think once that starts to happening, that's when the dam breaks. Because I'll add one final point, not to get too extended
No, far
here,
away.
which is a dear friend of mine. She's fantastic. She launched the Somm role, Claudia Somm. When you look at history, the unemployment rate doesn't gradually and marginally and incrementally tick higher over time. No, it jumps. So once you start to see this snowballing effect of job layoffs, you get a surge in the unemployment rate. And that's when you start to see the Sam's Club or the Costco lines or the nail salons dry up in their demand. And that's when you see a rollover in the main driver of the US economy, which is consumption.
You mentioned Costco. That's also one of my favorite places to shop. And you know what? Costco's selling a lot of gold bars. Hundreds of millions of dollars each month of gold bars online. Does that send any economic clues to you? Like, what's the read from that? Because to me, that's kind of crazy.
Gold is fascinating, and I think people are certainly starting to hedge their bets. And it's been one of my top performing calls this year, Brian. Coming into this year, my top call was utilities. Utilities in the equity space is up 30%. Over the past couple of months, there were several weeks where utilities year to date was actually beating tech. I was very proud of that. But the other call was gold, and gold has massively outperformed. The story up to what you mentioned, the recent interest and surge in demand for physical gold. Prior to that, the main driver of gold surge was central bank buying. We're talking China, Saudi Arabia, Russia. Price insensitive buyers are becoming less prone to buy treasuries and more prone to buy gold. Now what we're seeing is, on top of central bank demand, we're seeing real physical demand, and that's guys and gals who are concerned and are hedging their bets. And I think it makes perfect sense. I love the barbell strategy at this point. Yes, keep your tech positions, but in my view, and I've been saying this for some time, a judicious strategy is to protect your gains with cheap put options when the VIX is low, maintaining gold positions, have some amount of cash, and buy short duration bonds.
So do you stay long gold and utilities into next year?
Actually, at this point, I think that the trade has played out so beautifully that over the next week, this week, actually, I'm going to come out with a piece saying realize gains in utilities and rotate into the next most underloved sector from this year. which I think is going to outperform next year, which could potentially be healthcare. And then with regard to gold, I think it is getting long in the tooth. So I would also realize gains, anticipating some correction therein. So I do think there are opportunities to take gains after having had a tremendously successful recommendations across asset classes this year.
So I'm thinking back to January this year. I could remember anyone saying, go buy utilities. So that was like an out of the call.
Out of consensus,
So
yes.
what is it like taking that call to clients? Hey, buy utilities. At the same time, I guess NVIDIA might rocket 200% this year. I mean, like, how do you make that case?
Well, the really interesting thing was, I think at the beginning of this year, utilities was the most underloved, not sexy sector. I was on TV talking about it, and it's just not a fun thing to talk about. But I got it out there anyway, and I'm glad I did because it's massively outperformed. But my pitch was the following: utilities can outperform in different scenarios, and I think that's what a prudent investor wants. Utilities is the second derivative to tech. Now it's consensus. Back then it was not. So what does AI need? It needs energy. It's a massive consumer of energy. It also needs industrial real estate, it needs warehouses. So those are the second derivatives of the AI trade, which has already run its course, in my opinion. So we need to go and find who's catching those tailwinds. And then on the other hand, utilities is that unsexy sector that's defensive and outperforms in recessions and doesn't do that well in upswings. So you have that defensive aspect, and that's what I most loved about it, because I do think, Brian, that there are bipolar risks here, and they're fat tailwinds. One, we talked about at the beginning, a reacceleration of inflation because of a too strong economy, an overheated economy. And then on the other side, the other bipolar fat tail risk to this already priced perfect landing scenario is the recession risk, where you get some external exogenous shock or internal, such as mass layoffs responding to some margin pressure, and you get a contraction in the US economy. I think we need to protect against either of those bipolar risks, which are not insignificant in their possibilities. And the way to do that has been through utilities. This year, it's been through gold, and it's one of my kind of less performing strategies has been steepeners on the rates front. But I do think that's a structural call, and I'm holding on to that one.
All right, hang with us, Kathryn. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Having a great stocks and markets chat with Kathryn Rooney Vera, Chief Market Strategist at StoneX Group. Kathryn, you didn't get past me the fact that you're about to, I think, come out bullish in healthcare. And that is not lost on me, one, because a lot of the people that we talk to are really not invested in healthcare. And then number two, you had the new situation, the active situation with Pfizer and Starboard and Jeff Smith. Why are you starting to warm up to the healthcare trade? And do you read anything about this new activist situation that maybe the space is just too darn cheap?
Well, yeah, and it's a relative value call. I think coming into this year, our call was utilities because it had been devastated in markets, but also because of the reasons I had previously mentioned. Coming into 25, I think that if we are in a scenario where all boats continue to rise, and that's been my other strong call, which is the equally weighted S&P, if we do continue to see this momentum-driven equities upside move, then I think you do want to play the underperforming sector. So it's really less of a conviction call on the sector and more of a call on defensives, this barbell strategy where we're protecting ourselves with defensive sectors and ones that have underperformed this year. And it's one of the most underperforming and unloved sectors. Thereby, I'm warming up to it as a contrarian trade going into 2025.
What's interesting, you made a good point in one of your recent notes that I was able to check out. What if inflation comes back? So we have oil now, $75, $76 a barrel. Some traders are piling into potentially oil hitting $100 a barrel. Now this market rally post-Fed in September has been driven by thoughts of more rate cuts. But if inflation is going to start picking up, I mean, that's off the table. I mean, that's not going to happen.
It's interesting because the market is it does feel like a Teflon market. No matter what geopolitical conflagrations we have in the Middle East or elsewhere, the market is unrelentingly moving higher, and that makes sense because profits are good, and stockholders see upside to corporate profitability going forward. But when you look at at the potential for an oil price surge, it's really real. And I think that the spillover effect, it's not a one-shot thing. The spillover effect is very important. And when you combine that with the election that's in 30 days, and the potential for additional pro-growth measures and tariffs, protectionist policy on both sides of the aisle, I think that the risks to inflation, and we also talked about the overheating economy and the growth, which is above potential, are completely underpriced. So you want to be in inflation hedges. That's, I think, also why gold has done remarkably well. And I think that if you do get some even partial closure of the Strait of Hormuz, which I think shouldn't be discarded, especially if we get a worsening in the tensions with Iran, then you get a jump in oil prices. And I think a one standard deviation, and this is something that we did in-house, Brian, would take us $35 higher to about $95 per barrel. And the impact on a 1 year effect of that would be 1 full percentage point on headline CPI, which is not irrelevant. If I'm right, and if that's the case, then the Fed does not cut going into next year. And if in fact we get a reacceleration of inflation, dare I say that the markets will start to consider the possibility of renewed rate hikes. And that would be very negative for market sentiment, risk assets, and number one, tech stocks.
Rate hikes? That's no fun. I thought we were just done talking about that, but you do bring up a good point, because now the 10-year has crossed, the 10-year Treasury yield has crossed above 4%. And I don't think the market is paying attention to this. If it continues to rise a little bit more, I mean, does that spook stocks?
Well, yeah, sure, because the equity risk premium becomes again less attractive, and I do think that people would start to get more interested in the risk-free asset at those rates. But look, I think inflation expectations do not coincide with inflation risks, and I think that opens opportunities for savvy investors. Inflation expectations are phenomenally anchored, and that's great news for the Fed. But if you get an inflation shock, whether it be external or internal, then the Fed cannot deliver on the amount of rate cuts that are currently priced into markets. And I really do think that the Fed is unlikely to get there without a deceleration in the economy. If GDP nowcast is right from the Federal Reserve of Atlanta, and we get 3Q at 3%, that's not a recipe for 2% inflation. That's not even a recipe for a continued deceleration in the main drivers of inflation, which are namely services, ex housing, and housing. I mean, the housing market contributes almost 1 full percentage point to core PCE. Something's got to give. That's the bottom line. And I think that investors, while the markets are hot, while complacency and euphoria is still set in, while the VIX is low, that's when you want to buy those put options, which are cheap. Yes, they cap your upside, they limit it. But you'll be very happy if, in fact, we do get a correction over the next 12 months.
I'm still not convinced that inflation has come down a lot. I saw a $10, I hate to keep going back to this, Sam's Club, a $10 bottle of freshly squeezed orange juice this past. I've never seen orange juice priced for $10. I mean, it was good, but nonetheless. You did some interesting research, Kathryn, on, I want to make sure I had it right, on presidential, I wrote it down here as presidential predictions and the stock market. Yeah. Walk us through this, because I think it's some fascinating data that you pulled to life.
Well, Alan Lichtman did this really interesting analysis, and he's been right in every presidential election, save 2 over his lifetime, of the 13 keys. And one of them I dived into a little bit, which is short-term economic outlook. And I attribute most of that, this is my own proxy and my own views, but a lot of it has to do with the wealth effect from the stock market. So when you look over the past 100 years from the S&P 500, there's only been 2 instances where this has not panned out, which is in the 3 months prior to the presidential election every 4 years. It's very simple. If the S&P 500 is up over those 3 months period just before the election, the incumbent party wins. And it's been right in every single election, save 2. Since the beginning of the S&P 500. It's one variable, so I'm going to caveat it. It's just one input. It doesn't mean it's going to happen, but it is a pretty interesting indicator. So the S&P has been up the past 3 months, pretty remarkably, and that favors and bodes very well for the incumbent administration. There have been exceptions. Reagan was an exception. Nixon was an exception, and Eisenhower was an exception. This time could be an exception But at least when you look at the stock market as a leading indicator and a barometer for the presidential outlook, it's looking pretty good for a Harris administration.
What do you think that would mean to the markets next year then?
Markets are fully priced. I think everyone cares about what happens with Congress. If Congress is divided, then a Harris administration is less relevant from a market's perspective. A Trump administration is less relevant. Why? Because they can't implement their more populist, more extremist measures. So really do think it has a lot to do with the composition of Congress. And there I have a higher conviction. There's going to be a divided Congress, which means that we're probably not going to get a jump in the corporate tax rate or a slashing of the corporate tax rate. My suspicion is that we're going to get a bit more of status quo. And I'll add one more out of consensus view, which is there's this new euphemism, this new buzzword in town, which is, instead of protectionism, we're calling it industrial policy. Industrial policy has not only been bipartisan adopted, it's been globally adopted. Why? Because of the overcapacity or dumping of China. So we've seen tariffs on China from the likes of Brazil, Mexico, Germany, the United States. The Biden-Harris administration has maintained all of Trump's tariffs and added to them. So the truth is that industrial policy is protectionism. We've seen Yellen warm up and cozy up to tariffs, sanctions, and quotas. This is the new normal. I think over the next 4 years, whoever's in power, we're going to see additional protectionism, which is inflationary as well. Of course, if it's a Trump administration, we're going to probably get higher tariffs. But I do think in the net, Brian, unless we get a contested election and no outcome on November 5th, unless we get a contested election, I think whoever wins is likely market irrelevant.
With the couple minutes that we have left, we do a lot of research here on the Opening Bid podcast for each guest. Do I have this right that you worked at Bear Stearns?
Oh, I did.
What was that like?
I saw the $2 bill slapped on the door.
Oh, what was that like? That must have been wild days, right?
Oh, that was very wild. And it's so funny, Brian. It's like life lessons. When that closed, it felt like, the end of the world. But that was 15 years ago. I remember a friend of mine saying, the financial services industry, it's all over. It's just gone. Let's go into oil. I moved to Miami 15 years ago, right after that, and it's been a phenomenal trade. And now I'm the head of research here at StoneX, based in Miami, but the headquarters are in New York. But Bear Stearns was a fantastic place to work. I loved every second of it, and it was very sad to see that go away. One final thing I'll tell you is that I was going for my master's at night at that time at NYU, and 2 days before we closed our doors, I was raising my hand and defending Bear Stearns because that's what our CEOs were telling us. That was a Tuesday. On Thursday, I got back into my Stern class with 500 people, and the professor said, "Hey, where's the Bear Stearns girl?" I was like, "Oh man," rubbing it into my face. But no, it was a great place to be. Thankfully, we're not in anything remotely close to that. When and if we get the next recession, it's not going to be anything close to what we saw happen in the 2008 crisis.
Oh God, I hope not. That was awful. I was still kind of young in my career, and to open up a trading screen and see like stocks down 40-50% of like household name companies. I mean, it was scary times. But to your point, I mean, you learned a ton. All right, we're gonna have to leave it here for this episode. Kathryn Rooney Vera, Chief Market Strategist at StoneX Group. Really good to see you. Thanks for the following on social media. We will definitely be having you back very soon.
Thanks, Brian. Have a great day.
All right, you as
Bye.
well. All right, that's it for the latest episode of Yahoo Finance's Opening Bid. Please do subscribe on YouTube, listen to us on all major podcast platforms, hit us with those likes on Spotify. We'll be with you soon.